My name is Lewis McLellan. I'm the editor of the Digital Monetary Institute here at OMFIF, and today I'm delighted to be joined by Tony McLaughlin, founder of Ubix and author of the recently published white paper on Ubix, who many of you will have heard of as the originator of the Regulated Liability Network and its various offshoots. Tony, great to have you.
Yeah, it's a pleasure to be here, Liz.
All right. Well, so you've got this recent white paper that we're here to talk about today, Ubix. Do you want to we'll get into that obviously. Do you want to just give us the sort of headline of what the core concept is there?
Yeah, sure. I mean, essentially, the thing that I've figured out is how to make stablecoins cash equivalents. And, without expecting everyone to be accounting nerds, to my mind, the key of having widespread and ubiquitous acceptance of stablecoins is to have them recognized from an accounting perspective as cash equivalents. And that's what the Ubix clearing system achieves. And it also achieves some other related things, such as um, allowing stablecoins to exhibit the very important trait called singleness of money. So that's what the Ubix clearing system is meant to achieve.
Excellent. All right. Well, we'll get more into depth on what that implies. It's quite a powerful concept, and stablecoins have, I'm sure it won't be a surprise to any of our listeners, have really picked up in terms of the momentum that regulators and various businesses have at the moment. But Tony, let's hear a little bit more about you first. Can you talk a little bit about your background, how what you've been doing in digital payments up until now?
Yeah, sure. My background is pretty monoline. It's been 30 years in TradFi, 20 years with my last institution, always focused on payments, treasury, and FX. And essentially, the story is that up until the US election, I hadn't seen a clear way for banks to participate in public permissionless blockchains. And post the election, a pathway in my mind opened up for that. So the work that I'd done on regulated liability network, regulated settlement network, Project Agora with the BIS and the IIF, all of that was kind of predicated on the idea that we would be limited to using private permission blockchains. I had to change my thesis after the US election to recognize that it's probably going to be possible going forward for banks to participate in public infrastructures.
Yeah, and you did. I guess you saw that coming correctly. We then had the executive order on, I think, January 23rd about U.S. digital asset leadership, which specifically name checked public blockchains and bank participation in that. So that I guess was your prediction there was quite swiftly proven correct.
Yeah, it was, and there's still some things to overcome in terms of bank participation in public blockchains. But the pathway that I saw opening up is essentially making the argument that a public blockchain is just a venue for commerce,
Mhm.
and regular people and regular businesses will want to use that venue for commerce. So there are other venues for commerce, like a high street or the internet, where banks can participate, but they're not responsible for everything the bad that can happen on those venues. And actually, there's a greater harm if you prevent banks from participating in those venues. Because if the regulated institutions are not there, then the ecosystem participants find unregulated alternatives. There's a vacuum which is created. So the path that I saw opening up is just a recognition that blockchains will be a commerce venue, like the high street or like the internet, and it's better for banks to participate than not.
Yeah, I think certainly in the crypto industry uh there's been a lot of excitement about the idea of banks being able to participate as liquidity providers and market makers and so on. But let's talk about stablecoins specifically. Obviously, there's central bank money in the form of cash and central bank reserves, and then there's commercial bank money, which handles the vast majority of commerce in, on the internet and in the high street, as you mentioned. Can you talk a little bit about what stablecoins contribute to this sort of new venue for commerce?
Yeah, sure. I mean, stablecoins have become the default medium of exchange on open public permissionless networks. And of course, the original vision was to have peer-to-peer method of payment in a non-sovereign currency like Bitcoin.
Mm.
But because of the attributes of Bitcoin and especially the volatility, it hasn't really taken off as a method of payment so much as being a very volatile speculative asset that lots of people love for those reasons. But that use case dominates over the means of exchange use
Yeah.
case. And stablecoins have occupied the means of exchange use case on crypto ecosystems.
Mhm.
Many of my ex-colleagues in TradFi will be interested in stablecoins without having ever actually sent or received a stablecoin payment. One of my practical recommendations for anyone scratching their head and wondering what's my stablecoin strategy is, we'll start by downloading a wallet, Phantom Wallet or MetaMask, and send and receive stablecoin payments, and then you might see what all of the fuss is about.
Yeah, okay. And so, well, what is the fuss about? I guess the speed is obviously a big part and the ease of access, but yeah, what do you see as the fuss?
Yeah, well, the fuss is instantaneous value transfer, peer-to-peer on public permissionless networks that already exist. The big issue that I had in my previous work on private permissioned ledgers was that you can clearly articulate a value proposition to introduce a state machine into financial services. That's what a blockchain really is, a state machine.
Mhm.
I wrote a paper called Ready Layer 1 that I think very well expressed the reasons why introducing a state machine would be beneficial to complement the messaging layer that we already have in traditional financial services. But the fundamental problem with these private permission ledgers is it's a boot problem. You have to get everyone to agree to use the same state machine. And that's very tricky. So it's fundamentally an adoption problem rather than a technology problem. But in the case of the public permissionless networks, they already exist. My article was called Ready Layer 1, but in reality, Layer 1s are ready and they're open for business. And they're quite capable of supporting regulated business. Stablecoins have got tremendous attributes and some downsides. I think one of the big downsides at the moment is the market structure between the issuers and the receiving institutions or the off ramps, which
Mhm.
is essentially bilateral, and that's an impediment. Another impediment is the inability for normal people to deposit stable coins into their normal bank accounts or fintech accounts. And another impediment is the accounting treatment.
Mhm.
So all of those problems are resolved by the Ubix clearing system.
Right. Okay. Well, let's come on to that. But yeah, so just to restate what you're saying there, I can receive stable coins from someone in a wallet very quickly and easily, but connecting that to my bank or receiving bank money for that is not simple. I have to go to the issuer and get that paid out to the bank. It's maybe not very quick, and those relationships are, as you say, bilateral and have to be set up individually.
Yeah, well, the off ramps primarily today would be through an exchange,
Right.
or if you're a big guy, you can go to the issuer. But the issuer doesn't want to have relationships with everyone who's a token holder. And, not everyone, like a normal person receiving a stablecoin payment, the most convenient thing that they could do is to take it to their own existing bank or fintech, or deposit it through their existing PSP relationship.
Mhm.
And, as the conversation develops, I hope it will become clear that opening up that new channel, it's a little bit like adding a lane to the highway in LA.
Mhm.
The more lanes you add, the more traffic flows. It's not a zero-sum game.
Mhm.
So what Ubix will do is add a new lane to the highway that I think will multiply the flow by a factor of 1,000. And I think it will lead ultimately to stablecoins becoming ubiquitous and a very, very important method of payment.
Mm. Well, as you say, it is they have already had some pretty remarkable growth, and that is in the current system where they are pretty siloed and separate from the banking and payment systems that people ubiquitously use. So let's talk about the clearing system then.
Yeah.
How can this be achieved?
Yeah, so this analysis, I've had a lot of interesting chats with crypto people, and when I analogize stablecoins to check payments, I get some puzzled looks. But the analogy to check payments is quite good. So here's something to think about. In the US, there are 4,500 banks, large and small, and every single one of them can issue a checkbook and can issue checks. So if I pick five random banks, large or small, and I present to you a check from those five banks, an invented bank, Fourth Bank of Kentucky, 15th Bank of Albuquerque, when I present those checks to you, Lewis, you don't care about the issuer. And the reason why you don't care about the issuer is because you take those checks to your own bank and you deposit them. And $100 drawn on the Fourth Bank of Kentucky is the same as $100 drawn on JP Morgan, as long as you can, in actual fact, deposit those checks and get par value from your own bank. Now, the way that that actually works is your bank does not have a relationship with the Fourth Bank of Kentucky. Your bank sends those items through the check clearing system, and the check clearing system is a machine for claiming the money from the Fourth Bank of Kentucky. So I just ask you to make the following substitutions. Rather than the Fourth Bank of Kentucky, there's a stablecoin issuer. Rather than the US Postal Service, there's a blockchain, Solana, or what have you. Rather than there being a physical piece of paper, there's a digital token that represents the claim on the issuer. And how I see it working, Lewis, is that actually your bank or your fintech will provide you with hosted wallets into which you can receive those stablecoins. And then your bank or your fintech will offer you a very simple service, which is convert $100 of stablecoins into a $100 bank balance or e-money account balance. Now, once your bank receives those stablecoins from potentially hundreds or thousands of issuers, it cannot have a bilateral relationship with those issuers. And that's what the Ubix clearing system provides. Ubix clearing system is the connection between the receiving institution, your bank or your fintech, and many, many issuers.
Mm.
So
Is hub and
that's how,
spoke, sorry. I was going to say, is hub and spoke the appropriate description of that kind of architecture? Or I mean, we're talking about something decentralized, so maybe that's a little misleading.
it is misleading because the way in which these things have been done in the past, like in the 20th century, these things have been solved, like the many to many relationship for checks issued and checks received is solved through a centralized infrastructure.
Mhm.
The many to many relationship between cards issued and cards accepted is solved through centralized infrastructures. But the many to many relationship for stable coins should not be resolved through a centralized infrastructure. So when we build Ubix, we'll be building it on the principles of progressive decentralization. So even although we're resolving that many to many relationship, through a clearing system, that clearing system can be progressively decentralized at the level of the rule book and at the level of the governance and at the level of the technology. So we're solving the same many to many problem, but doing that in a 21st century way.
I see. And can you just quickly give people a sense of why not do this in a centralized way? What is the value of doing it in a decentralized context?
Yeah, well, this specific ecosystem is made up of some interesting bedfellows.
Mm.
On one side, you have crypto natives who care about things like peer-to-peer transactions without intermediaries, and trustlessness and decentralization. On the other side of the ecosystem, you have TradFi, you've got banks and fintechs, and
Mm.
they have a different set of concerns. And then, all around this, you have the other constituents who are the regulators and the central banks, and they care about singleness of money and cash equivalence and security and soundness of the payment systems.
Mm.
So Ubix is really trying to articulate the common interest between these three different constituencies.
Yeah.
And there is an area of common interest. But to achieve that common interest, each of the parties has to understand and accept some of the central tenets of the other. Now, one of the central tenets of the crypto community is decentralization.
Yeah.
And actually, it's good because it will lead to a more resilient infrastructure and self-sustaining infrastructure. So all of that is good.
Mm-hmm.
So there's a path of progressive decentralization for Ubix, which will meet the expectations of the crypto side of the ecosystem without alienating the traditional side of the ecosystem.
I see. Um, let's talk about this idea of alienating incumbents. I think often, solutions for payments problems from the DeFi community are met with some resistance from TradFi, who might be concerned about encroachment on, business on revenue streams, right?
Yeah.
Transaction services, businesses, etc. What you're talking about is involving the banks quite heavily, so possibly that will not be an issue. But can you talk us through a little bit about how this becomes a revenue stream for banks if they're going to be losing commercial bank money payments,
Well, I mean, there's
if they
there's
are going to be losing that?
there's two sets of impediments. I mean, one impediment is the bank's ability to engage in public permissionless blockchains,
Sure.
and that's something where essentially regulators should not expect a bank to apply traditional third-party risk management or outsourcing evaluations, because the minute you pick up your questionnaire that you would apply to a normal third party, you can't answer that if you're trying to transact on Ethereum.
Mm.
So that's one thing that has to be overcome. The next thing that has to be overcome is, in fact, the incentives for each participant to collaborate without having to trust each other.
Mm.
And I mean, one of the geniuses of Bitcoin and Ethereum and other networks is the distribution of incentives such that a community can collaborate in a trustless way.
Mm-hmm.
So in Ubix, we spent a long time thinking about how the incentives get distributed across the ecosystem between the issuers and the receiving institutions. And essentially, to make it very simple, Lewis, if you're in the UK
Mm-hmm.
and your bank receives a dollar stablecoin, then your bank has an opportunity to charge you something. It's up to the bank. In Ubix, we don't set the prices,
Mm-hmm.
but they will be able to charge you some fees and some foreign exchange spread in order to collect that money on your behalf.
Right.
So there's a revenue pool, a net new revenue pool for the financial institution.
Mm-hmm.
And then the Ubix clearing system charges a small platform fee, and it also passes back a redemption fee to the issuer that could be seen as an analog to card interchange.
Right. Yeah.
And the reason why that's so important is because at the moment, stablecoin issuers survive on the yield on their collateral.
Mm.
And so they have massive interest rate risk and dependency.
Yeah.
And what Ubix does is introduce a completely new non-interest income stream,
Mm.
which is derived from the redemption activity.
Yeah, which I guess very important if, we've seen this explosion in stablecoin volumes at a time when interest rates are quite high, and we've not seen that business model tested through an economic cycle, which, yeah, will be a very important stage.
No, it's extremely important that the stablecoin movement is not dependent upon interest rates.
It's a little bit analogous almost to In Bitcoin, the mining rewards, the creation of new Bitcoin
Yeah.
are halving and going away, but miners will the transition, the hope is that the transition goes from mining new Bitcoin to transaction fees. So it still
Yes.
becomes economically worthwhile to do it.
Yeah, absolutely, absolutely. The economic incentives across an ecosystem like this, if you want it to scale, have to be aligned.
Mm,
That's one thing that the cards ecosystems have done well. They align incentives across the ecosystem, which is designed for hyperscaling,
yeah.
and Ubix attempts to do a similar thing. But I'd like to make one point, which is, again, when you analogize the legacy clearing systems or payment systems to stablecoins, crypto people can get very upset.
Mm,
But the truth of it is that these analogies are nothing to do with checks or cards or stablecoins. These analogies are to do with any planet that has a system where you have claims drawn on issuers, which are redeemed by accepting parties. I mean, there is some far off planet with where there are clans of crabs who issue, shells
mhm.
of different colors as money, and the lobsters accept them and provide goods and services. In that, on that planet, the seahorses get together and build a clearinghouse because there's a many to many relationship between issuers of the instruments and the receivers or the acceptors of the instruments. So there's no need for the crypto community to get upset about the comparisons to credit cards and checks. If we prefer to analogize it to the seahorse clearinghouse between crabs and lobsters, that works equally well. It's about networks. It's not about legacy payment types.
Yeah. Um, One thing that this does rest on, the being able to clear a check from any bank rests on the assumption that the bank is adhering to standards of capital adequacy and that
Yes.
the checks that are issued are backed by a certain amount of reserves. Can you talk about how that is, in stable coins, we have a lot of different regulators coming up with a variety of rules for how stable coins should manage their reserves.
Yeah.
Can you talk about how banks, maybe do we have to wait for every regulator that is governing a jurisdiction where a stablecoin is issued to have rules in place here, or how does that work?
Well, let's go back to that check analogy. And again,
Mhm.
let's not take the analogy too seriously or too dogmatically, but let's note that all of the check issuers are regulated.
Mhm.
But here's the interesting thing, they don't all have to be regulated in the same way.
True. Yeah,
So,
it depends on the size of the bank or whatever. Yeah.
well, not only does it depend on the size of the bank, but also in the US, you can write a check against your money market fund.
Right.
And also, this is something that you definitely will not remember, Lewis, but back in the 1990s, American Express used to give people checkbooks and you could write a check against your credit limit.
Right.
Now, this is super interesting because again, if I give you three checks, Lewis, so if I give you one drawn against a bank and one drawn against a money market fund and one drawn against the credit limit provided by American Express, you still don't care about the issuer
Mm.
because you take those three items and you deposit into your own bank account and you get par value.
Yeah.
And you get par value because of the clearing system.
Yeah.
And not only are the issuers regulated somehow, not all the same, but somehow, but the clearing system has got a rule book. And what the clearing system really does is it homogenizes the issuers.
Right.
So here's the thing when it comes to regulation. Regulators at the moment are conflating the instrument with the issuer in a way that's, I think, not helpful.
Mm.
So the instrument is one thing, which is the token, which is a promise to pay on the par value on demand by an issuer. That's one thing. A separate thing is the issuer.
Mhm.
So in the paper, we described this concept of general purpose stablecoins. And in reality, in today's world, okay, the issuers all look like non-banks, which have fully collateralized they're fully collateralized and they're issuing against that kind of backing.
Mhm.
But there's, in actual fact, when the clearing system exists, there's no reason why you can't issue a stable coin against a bank balance sheet. There's
Yeah.
no reason why you can't issue a stable coin against a money market fund. There's no reason why you can't issue a stable coin against a line of credit, as long as those tokens can be presented for clearing at par value. So this is, I think, a way of thinking about what stablecoins are that point to a much more general purpose understanding of stablecoins than we have today.
Yeah, as a tokenized instrument of a tokenized form of cash, if that's the word we want. At the moment, we have this system where the term stablecoin is used to describe not just a tokenized form of cash, but that token being backed by high quality liquid asset reserves, one to one rather than other things. But you're talking about a new definition of that, where it's the fact that it's tokenized rather than what it's backed by.
Well, let's just again use this analogy, which is imagine we go back to the very, very beginning of checks, and imagine that the imagine that the only issuers of checks were non-banks who were fully collateralized. Now, if you play it forward, and if you had regulated checks and said a check is an instrument which is issued by a fully collateralized non-bank,
Mm.
you would have made a terrible mistake. And you would have dramatically inhibited the potential of checks. Now, checks are passing into history,
Yeah.
but checks are much more general purpose than you might have thought if you just looked at the first check issuer.
Mm.
And stable coins are much more general purpose than what you see by looking at the issuers who are in the market today. So some people look at the market today and they see an oligopoly and they think it's always going to be an oligopoly. But that's not what's going to happen. Every bank in the world can issue a checkbook. Every bank in the world can issue a credit card. Every bank in the world can issue a debit card. And that's the world we're moving into with stablecoins. But that world is only possible in the presence of the clearing system, because the real problem at the moment of being a successful issuer is you have to build your own acceptance network. The moment there's a mutual acceptance network, the cost of being a stablecoin issuer becomes very, very low.
Mm.
And so that's why I suggest to you we're entering into the stablecoin epoch. Every regulated institution, here's the strategy. If you're scratching your head to say, what's my stablecoin strategy? It's quite simple and it's got two parts. Enable your customers to receive stablecoins in multiple blockchains, multiple issuers, and enable your customers to switch into bank balances at par value or fintech balances at par value. That's on the incoming side. And then enable your customers to pay with stablecoins. Now, that could be a third-party stablecoin, but over time, it's likely to be your own stablecoin.
Mm.
Because issuing your own stablecoin becomes easier, much easier, if there's a mutualized acceptance network.
Yeah. Um, you're talking about, multiple blockchains, multiple stablecoin issuers. Uh, Obviously, going back to the analogy of any bank, but they're all regulated, or any
Yes.
check issuing institution. Um, can you talk a little bit about the standards that will be required to be a participant in the
Sure.
theory?
So, like any clearing system, there will be a rule book. Now, these rule books um, are all across the ecosystem. There's a CLS rule book, there's a Visa rule book, a MasterCard rule book, there's a CHAPS rule book, a CHIPS rule book. Every single one of the clearing systems has got a rule book. And the amazing thing is that the headings of those rule books are all the same. So they're all logically talking about the same kind of relationship where you're resolving a many-to-many set of participants. The special thing about the Ubix rulebook is that it will be developed as an open source project. So the rulebook is on GitHub. And I mean, look, at the end of the day, a rule is text and code is text. So each rule in Ubix is a block of text in GitHub. And anyone in the community can suggest a change to that text. And then the question is, how do you decide which changes get committed to the sacred timeline? And ultimately, that will get done when we complete the path of progressive decentralization, or as we go through that path, that will be decided by the community. So Ubix will have a governance token, and those governance tokens will be used to vote in the DAO on rulebook changes. And here's the thing: when we look at these clearing systems, yes, the brands are valuable and interesting, and the technology does its job. But the real value and the really important thing is, what are the rules?
Yeah.
And the big question is, are the rules controlled by a centralized authority, or are they controlled by the community? So in Ubix, the line of travel is that the rules will be controlled by the community. But that obviously has to be consistent with regulatory expectations.
Yeah.
And if you can't just change a rule that makes thousands of participants update their systems on the next weekend. So that's why that path to decentralization of the rule book and the voting through the DAO has to be done in a judicious manner.
I see. Yeah, it's going to be uh that form of community governance is very comfortable for the crypto community, but less so for the TradFi and regulatory community. Although they do plenty of public consultations, they know about the importance of the community in informing the rules, but they're used to being the trusted central party that actually has the final decision.
They are, and you say that the community governance is comfortable in the crypto community, but many DAOs don't function well.
True.
So governance is not easy. Governance is something that has to be worked on very, very, very hard. And it's actually the critical success factor for Ubix is to get the governance right and get the community governance right. But I know for sure what is wrong, and what would be wrong is for us to have a centralized rule book that is used to compel the community to do things that it doesn't really like.
Mm.
So community governance in Ubix is the reason why we will have the token. The token will also be used to pay fees. We'll have a separate white paper for the token in due course.
Mm-hmm.
But it's a very important part of the progressive decentralization journey.
Yeah. It is interesting, although I say things like regulators are not comfortable with this idea of community governance, it's painting with slightly too broad strokes. There's been plenty of papers from the European Commission and others talking, and the ECB talking about the value of public permissionless systems, and what they all say is that the core of it is this decentralized governance model that can't be used to um, ring fence or protect incumbent institutions, etc.
Well, there's incredible resilience to be
Mm.
achieved. Imagine this. So the way in which I see this happening is that in today's world, Lewis, you log into your bank account and your bank gives you an IBAN, which is an address for receiving a wire payment or a credit transfer.
Mm.
Now, imagine tomorrow you log into your bank or your fintech, and all of a sudden you see 10 addresses. There's an address for each blockchain. These 10 addresses are actually 10 separate and parallel and independent transport mechanisms. So they're all independent of each other, and they're independent of the faster payment system or the instant payment system. So the moment your bank enables you to transact on 10 different blockchains, What it's really done is create multiple redundancy.
Mm.
Because the moment we achieve the cash equivalence for stable coins, and those stable coins can live on 10 different blockchains, then the global financial system has become multiply redundant. And that's an enormous benefit for the system as a whole.
Yeah. Yeah.
Cash equivalent stable coins on 10 different blockchains within your existing financial institution has made the world's financial system massively more resilient than it is today.
Yeah. And people are so used to the status quo, we often don't hear about or it doesn't really register with us just how much downtime there is at existing centralized systems. Um, I'm conscious we're going fairly long here. Are there any other features of the Ubix system that you want to touch on before we get into, the execution plan, the strategy from here? Any other things that I haven't touched on that you want to
Well,
highlight?
there are many that people can find in the white paper.
Sure.
I've made a serious attempt to make the white paper self-explanatory and logical, moving from the problems to the solutions. Ubix, I think, delivers great benefits for the issuers and receiving institutions, the blockchains, and also the regulators.
Hmm.
There is a sweet spot in the middle, which is an area of common interest. It does require some forbearance, uh, you know, recognizing that there are things that each party needs and wants and is interested in that might not be the top concern for the other. There are terminology differences as well, which are very triggering, for other parties, and we have to get over that. But I hope people can take a look at the white paper and see the way in which the Ubix clearing system brings together different constituents into a common project of great importance.
Yes, I will link it from the description of this podcast, so you should be able to find it very easily if you're listening to this. Um, all right, well, let's talk about yeah, what's next? The white paper's out. What comes after that?
Yeah, we've also launched something called the Ubix Association.
Hmm.
And the Ubix Association is really a way to give people an answer to that question of what is my stablecoin strategy.
Mm.
The stablecoin strategy for most organizations is, as I mentioned before, enable your clients to receive stablecoins, enable your clients to hold them, enable your clients to pay stablecoins, and ultimately, if you want to issue your own stablecoin, connect into multiple blockchains at the same time.
Hmm.
So there's very specific ways that we can help organizations go on that journey, build the business case, meet the partners, educate themselves about the blockchains and the issuers and the partners who can help provide these hosted wallets. All of that will be made available within the Ubix Association that people can join at any time. And we're building the clearing system, and the clearing system will go live this year. The minimum model that essentially demonstrates the resolution of the many-to-many relationships is two issuers, two receiving institutions, and two blockchains. Now, once we go live with that model, every time you add an issuer or a receiving institution, the value of that network scales quadratically by Metcalfe's law.
Mm.
So the network effect, as soon as we break the one-to-one model and then move to two-to-two and then start adding on both sides, the network on effect on that will be unstoppable. There will be hyperscaling. There'll be hyperscaling of the more issuers you get, the more receiving institutions are interested. The more receiving institutions you get, the more issuers are interested, and it will, to my mind, soon become the new market structure for stablecoins.
Mm.
That is the objective of Ubix as a company, is stablecoin ubiquity. And our answer for that in the white paper, people will be looking to the white paper for a bunch of technical details. And what I've learned over my years is that the technology is important, but in a sense, it's somewhat arbitrary. And what I mean by that is there are multiple technologies that can deliver the same result,
Mm.
but there's only one economic model that can deliver the result. And that economic model is about the distribution of the rewards across the ecosystem.
Yeah.
And so Ubix, more than a technology model, is an economic model for hyperscaling stablecoins by collaborating or getting competitors to collaborate.
Yeah, yeah, and I encourage everyone to read the white paper, which, as Tony alludes to, does contain very clear descriptions of the economic incentives and how they map out for different participants. Um, just in terms of the potential hurdles for this scaling at banks, what does the technical lift look like? I mean, presumably plugging in something like the Ubix clearing system is not that much, but they also have to have the facility to receive stable coins, and that means
Yes.
wallets for clients. What does that look like?
Yeah, exactly. That's exactly what it means. So a TradFi player, what do they need to do? They need to give their client those addresses, which means running hosted wallets. Now, for most banks or fintechs, they won't necessarily want to put in place that infrastructure themselves. So Ubix will have a series of what we call Ubix scaling partners. And those scaling partners will provide a bank essentially with a box of capability. Inside that box of capability, there will be hosted wallets, blockchain analytics, tokenization, and that will be an API connection into the bank or the fintech.
Mhm.
So you're going to get a connection to the Ubix clearing system and the hosted wallets and the risk management in a box from a service provider. And there'll be many of these service providers who are providing essentially the picks and shovels to the receiving institutions and the picks and shovels to the issuing institutions.
Yeah.
And this is something really to think about, which is look at the card ecosystem. The
Mhm.
card ecosystem has got the central scheme, but it's also got a huge number of symbiotic businesses who drive hyperscaling, like the acquirers and the PSPs and the companies that help people issue and help people accept, the processors. These are all symbiotes in the card ecosystem that drive hyperscale. And there will be tremendous opportunities in the Ubix ecosystem for these symbiotic business models to do extraordinarily well.
Yeah, and I think a lot of these businesses already exist. They're just not able to sell to banks very easily at this stage. Is that, yeah.
Yeah, there's a fundamental ecosystem coordination problem where the banks and the fintechs and the issuers are all kind of doing their own thing at the moment. If you think about it, if we were back in the 1970s, Lewis, and you were running the only credit card company in the world, you have to knock on every single merchant's door to get acceptance. That's kind of the status that we're in at the moment, where we're at the very, very beginning of a new instrument, and people are trying to figure out the answer on an individual basis.
Yeah.
And the answer is actually on a collective basis.
Yeah. Yeah. Very, very exciting. We are running short of time, so if we can finish up, what should people do if they're interested? How does we've talked about where you're going next with setting up the clearing system and so on, but yeah, how can people get involved?
Read the white paper, join
Mhm.
the Ubix Association. That's it.
Terrific. Well, I'm sure many of our members will be extremely interested in that. Very, very powerful idea with some really incredibly transformative potential. So very excited to be hearing about this from you, Tony. And the white paper is a great read. I'm sure everyone in this space has read a lot of white papers in their time, but this one is really very worth your time because of that potential that it has. So yeah, keep an eye on developments there. Join Ubix Association. Uh, Tune in to the DMI podcast for more on this. I'm sure in the future we'll have you back on to talk about the next stage, Tony. And yeah, looking forward to hearing more. Thanks for
Yeah,
joining
thanks
us.
very much, Lewis.
Terrific. Thanks for listening, everyone. Make sure you check out the website on fifth.org, details of upcoming reports, commentaries, upcoming events like the Digital Money Summit, at which I think we'll have Tony speaking in 20th, 19th, 20th and 21st of May, excuse me. Thanks for listening, everyone. Goodbye.